Hello, ladies and gentlemen. Okay, welcome to the Shore Financial Property and Finance podcast. Today, we've got a very special guest. We've got Rich Harvey, the founder of PropertyBuyer. Rich is a very well-known buyer's agent across Sydney. He's often on the news, you could say, for quoting his insights. He's got an extensive background. He's a licensed real estate agent, a professional economist that's been an economist for over 20 years. I think you've also sat on the boards, I believe, here for the REBAA for 4 years.
Real Estate Buyers Agent Association.
The president, I should say.
Yes.
And then also the chairman of the Buyers Agent chapter of Real Estate Institute. That's a mouthful, but you're there for about 9 years. Core markets you like to focus in, eastern suburbs, North Shore, northern beaches, but you also do some development sites, commercial, and you look at other markets like Brizzy and WA. So great person to have on board to our podcast. Thank you so much for coming.
Great to be on, Theo. Pleasure. Love to share some insights today with you.
Yeah, so let's this is our first podcast for 2024. So we should probably do a bit of a recap on the year that was 2023 and the year that's shaping up to look like 2024. Crazy sort of 6 months. So we went into the tail end of last year. That last quarter, we sort of lost the wind out of our sails, you could say, with the forecast of interest rates changing around October, right as that war in Gaza also erupted. Everyone thought that rates were going to come down early this year back then, and then all of a sudden in October, the US Federal Reserve came out and said rates are going to go back up. That changed confidence in the marketplace, and people just stopped looking in that last quarter of last year, right? People sort of put their buying plans on hold because they were expecting that these high rates were going to be for a short period of time, but then they found out and were watching the news and thinking maybe not. Maybe it will be high until 2025, which was the concern. Then that forecast changed again. It's never been constantly changing as much as it has been recently. And the start of this year, it looked like now that inflation is steadily decreasing, and there was some alarming consumer spending data that came out, the retail spending data in the December quarter that was a bigger decrease than expected, about 2.5 or 2.6% off. Those two sort of pieces of information and coupled with what was coming out of the US meant that now the forecast is for rates to come back down this year, not stay high throughout 2024. Half the major bank economists are saying that rates should come down in sort of May, June. The other 2 out of the 4 are expecting later this year. So confidence is back, momentum's back in the market. There's an increase in stock, but the clearance rates of auctions are staying strong. There's the increase in supply is being met with demand. So on that note, what are you seeing?
Well, a lot in there, Theo, in that introduction. I think just to sort of recap on the end of 2023, we saw the interest rates really put the carbosh and the brakes on the market. And we saw a lot of buyers just put their plans on hold going, gosh, we don't know how to cope with high interest rates. There was still fear that there'd be more interest rate rises above the 4.3% cash rate. But what's actually transpired is that the savvy buyers were still buying up at the end of last year. When everyone was running to the hills the other way, the savvy buyers were still out there looking. So, we did see it.
And they got good value, right?
Well, they definitely got good value. But I've got to say that at the first sort of 6 months of this year, to be honest with you, will probably be really good buying opportunities. And we'll get into that in a moment. But going back to your comment about forecasts and economists, they always get it wrong. And they always got to adjust it, right?
Yeah, last year they said that the market was going to come off and every market increased.
Well, we had an unusual situation. It's only been about 3 or 4 times in the last 20 years where you've had rising interest rates and rising property prices. And it's fundamentally driven by an undersupply property.
Especially in Sydney, right?
We're not building enough properties to cope with demand. And we'll talk about migration later, but that's been a major factor. 510,000 migrants coming to our shores in 2023. Now, building approvals were probably down from their normal 180,000 per annum numbers down to about 140,000.
Which is back to about a 10-year low, I believe, right?
Absolutely. It's way low. It's incredible. Both units and dwelling houses are way below the long-term averages. So that's a big problem for our economy and for housing in general.
And just on that note, actually, because we had the chief economist, the former chief economist of the RBA and the CBA in one of our previous podcasts last year, Michael Blythe, and he was talking about that supply issue not being an overnight fix. It could take years before we see an increase in supply, because you can sort of forecast supply with, you can forecast supply with building approvals, right? And the building approvals are dropping off too.
Well, there's a structural problem that we've got, and there are no easy fixes. I mean, The Greens are talking about getting rid of negative gearing and putting rent caps on rents, which is just two policies which are just diabolically, ridiculously in terms of the outcome that would deliver to the market.
For supply, yeah.
Absolutely. If you get rid of negative gearing, it's been proven that over 80% of those using negative gearing are mum and dad investors and ordinary wage earners, not the wealthy end of town. And that's really not going to change. What that would do was put even greater pressure on public housing.
And rents.
And rents as well. And rents would rise, right? Putting a cap on rents, we're not a command and control economy like, in communist countries here. So putting a cap on rents is ridiculous. Sure, you've got to, have a free market system and there's protections for tenants, but at the end of the day, investors need to be incentivised to rent out properties correctly.
Let's just break up that comment a little bit to explain in more layman's terms, I guess, to some of our listeners. So obviously, if you make purchasing investment properties less attractive for investors by abolishing things like negative gearing or reducing the capital gains tax discount that investors get on the growth, then naturally there's going to be less people buying investment properties, meaning less properties for tenants to rent. We should be doing the exact opposite. Already there's been a decrease in investors because ever since really the 2019 or leading into the 19 Royal Commission, that's when they introduced the difference on owner-occupied investment lending. We had higher rates introduced for investment loans and interest-only loans. And ever since then, there's been a bit of a sort of steady decrease in investor activity. It still goes up and down, but it's already becoming unattractive for investors. So we shouldn't make it any worse for them.
Exactly. Well, just look at what's happening in Victoria. The state government down there is increasing land tax, right, for investors. So unfortunately, a lot of investors are throwing their hands up. It's all too hard. I'm going to get rid of my investment properties. So again, they sell them. That's going to have less rental properties in that market going forward. So it is a real problem for both renters and future home buyers.
So why don't we talk about some of this a great property data that you have here, because you're one of the buyers agents that I follow closely because you're very data driven, which is great.
Absolutely.
We've done some joint webinars in the past. We've got one coming up that we'll share later. But let's talk about...
Well, I think, just to sort of kick off this year, I think we saw the market really took a bit of a dive toward the end of last year. We still saw price rises, and we definitely got through that correctional phase. We saw 13 interest rate rises. The interest rates have now peaked, and the auction volumes were still pretty steady, but they weren't big volumes at the end of last year. But this year, even last weekend on February the 24th, depending when you're listening to this, last Saturday, we had over 1,000 auctions in Sydney and a clearance rate of 73.7%.
Wow.
So that's pretty decent.
So can we compare? I've seen this report before. I believe it also compares the same period last year, not the tail end of last year.
Correct. The same period last year, we had 686 auctions with a 74% clearance rate. So almost the same clearance rate for almost not quite double the number of auctions.
Yeah, but almost double, right? Yeah. So there's almost double the volume of stock,
That's right.
but clearance rates are remaining steady. And that wasn't an anomaly last weekend. It's been like that throughout the year so far. Most Saturdays have had about double the volume, but strong clearance rates.
Even the first 2 weeks, we got over an 80% clearance rate in the first and second week in Sydney. And if you look at Melbourne's numbers, 1,263 auctions with a 68.5% clearance rate. Same time last year, 986 auctions with a 73% clearance rate.
So what is that? That's just, in my opinion, is that, I think it's pent up demand from people that checked out last year with the uncertainty of interest rates and everything going on. They put things on hold, but now they're like, okay, I'm making a decision.
I'm making a decision to change, sell the house, going to have the next phase of my life. I'm pulling the trigger. And I think people are realising that there's no perfect time to sell, right? There's no perfect time to buy, but they realise that if they don't sort of make a move now, it's going to be harder to get in later on. So maybe they're thinking, you know what, I'll put my property on the market, it's a reasonably good price, and then I can start looking for my next place. So it's good to have that kind of trade going forward as well. I mean, one of the things that's been pushing the consumer sentiment down, it's been bouncing around about 80 basis points, and that's been low pretty much over the last sort of 12 months. And unfortunately, cost of living pressures and high inflation is really keeping that lid on retail spending and that sort of thing. So unfortunately, that depressed consumer sentiment flows through to property demand. But I do think confidence is starting to really rise at the beginning of this year as we go forward.
Yeah, there's been some shift in people's spending habits. I think we touched on that in previous podcasts as well, where I think supermarkets are up. People are cooking at home more, and sort of hospitality venues and whatnot are down. And discretionary spending as a whole. That was the data that came out a few weeks ago. Department stores, retail, sort of online department stores and retailers are taking a bit of a hit at the moment.
You can see it, yeah. So if you just want to talk about price changes over the last 12 months, Theo, we've seen that the Perth market has been the outstanding performer. It's year to date, it's risen 16.7%. Closely followed by Brisbane at 14.8%. And then we've got Sydney, 11.4%, Adelaide, 10.3%. And Melbourne's been an underperformer at 3.9%. Canberra, 1.2%, and Darwin and Hobart just went back marginally.
So going back to your point about economists getting it wrong, right? That last year they were all forecasting for the property market to come off. And it's funny, talking about sentiment and consumers these days being more reactive to, I guess, information and media, especially because it's so readily available these days. Last year, the property market increased across the country, to your point, despite that interest rates were peaking at record highs. So borrowing capacities, crippled to record lows. It's been the highest rates we've seen pretty much in 10 years since the GFC. We had in 18 months a 47% decrease in borrowing capacity subsequently. But property prices still grew. Ironically, the year before in 2022, that's when we took a bit of a hit in prices purely because of the expectation of rates going up. But they were still low back then.
That's right, exactly.
It's interesting.
Yeah, interesting phenomenon, yeah.
Let's talk about population.
Yep.
I've got some data here that I'm sure relates to what you're talking about. So, we're seeing some significant increases in population, like you touched on. Historically, the Domain has released some information that a 1% increase in population equates to about an 8% increase in prices. And we're expecting some significant increase in population across Australia. The areas which are probably going to benefit the most are obviously the major cities where there's going to be job opportunities, but the areas where, going back to Sydney, where there's low supply in particular. So some of the data that we have talks about supply levels across Australia. Well, if you're watching this podcast online, you'll see a slide right now talking about Australia's housing supply, and you can see that population supply level change. It's the big V-shaped sort of recovery from COVID, you could say. And then you can see, to Rich's point earlier, that housing supply, or I should say dwelling supply, that's both units and houses, is back to a 10-year low. Hasn't been like this since about 2013, 14. So naturally that puts upward pressure on prices, right?
That's right. I think if you look at the migration numbers, as I said, we've had 510,000 people coming in last year in 2023. We're expecting around 350 to 380,000 migrants to hit the shores this coming calendar year in 2024. And then the following year is probably going to drop back to sort of the normal rate of around 250,000 to potentially up to 300,000. The main reason the government has turned on the migration tap is simply because of job opportunities and job shortages, skill shortages. So we just don't have enough skilled labour and unskilled labour at the moment in a whole range of industries. And now the problem is that's hampering productivity for Australia. If we don't import that kind of labour, then our economy will decrease in size. We could actually end up having a technical recession. So the government, it's a real tough balancing act for them because they need to have population increase through your skills migration program. But the problem is, on the housing side of things, we're not keeping up with demand. We're not keeping up with the supply.
That's why they're not just focusing on bringing in certain professionals like, medicos and sort of the white collar professionals, but also labourers and trades, because apparently in the construction sector right now, you might have seen it on the news the past week or so, there's a huge decrease in new apprentices joining sort of various trades like carpentry. And the government's trying to I think it was the state government trying to create some incentives to get people back into those apprenticeships. But at the same time, open the doors to migration in those trades as well, which is great.
That's it, yeah. So it'll be interesting to see how it works out this year.
The other thing that is worth mentioning, obviously, we won't go on about it too much because it got a bit too much airtime in the last sort of few weeks, but the stage 3 tax cuts are coming through. The major beneficiary of that, beneficiary I should say, is people earning around 140,000. So if you're once again watching this online, you'll see a sort of a slide on the screen now. If you are in that $140,000 bracket, you probably get about a 6% increase in your borrowing capacity because of the difference in your net income, and banks calculate serviceability on net income after tax. People above sort of 120 got no, or 120 grand income, got no benefit, no change. The only change in terms of tax is the actual brackets in which that kicks in at. The other thing that's worth mentioning, this only came out actually on the weekend that just passed, but there is some changes to superannuation, which I'm very happy about personally, because once again, I think the government should be creating incentives for people to put money in super, not the opposite. We had a decreasing capped amount in concessional contributions, being the contributions you can make which are tax deductible, things like salary sacrificing and getting a tax deduction on them, the before tax money. That's increased back to 30,000, which is great, effective from the 1st of July. That also then affects the non-concessional contributions and the bring forward rule, where you used to be able to do 110,000 a year as a non-concessional contribution, which is after tax money. That's now 120, and you can do the bring forward rule and do 3 years at once, I should say, for 360. So lots of great ways to put money into super at the moment. The other thing I should touch on that not many people are aware of, because we feel that SMSF lending and purchasing a property in your SMSF is a really rising topic at the moment. You can also backdate the concessional contributions if you haven't made the full, let's say, 27.5 per year each year for the last few years. You can go back 5 years. So you could put, let's say, in theory, roughly $100,000 into your superannuation potentially, which is a deduction that year. So you're pretty much getting a rebate back. I personally love the idea of purchasing in super, because the important thing to note is that the debt on the property that you buy in your super is excluded from your personal servicing and balance sheet. That's a major challenge for most of our investors that buy properties in their personal name.
They run out of serviceability in their personal name, and you could do it now through your super. It's a whole other avenue, isn't it? Right?
Spot on. And whilst they might get serviceability to stack now, it influences, or it affects, I should say, a future decision where you're trying to upsize the home or do a cash out to renovate the home or something of the sort, and all of a sudden you've got this investment property. Whilst it might be positively geared in actual terms, it's affecting your borrowing capacity because the bank puts that healthy buffer on it. So I personally think buying a property in your super is a fantastic sort of wealth creation strategy, especially because it's the only thing that you actually will forget about until you're retired. And the best thing is then when you are retired and in pension phase, it's entirely tax-free. No capital gains tax and no income tax on the rent or the sale of the property.
I was just about to make that exact point, that once you're in that pension phase, you pay no capital gains tax once you sell the property. You may not want to sell the property, though, mind you, because for us, when we're guiding our clients in buying properties in their self-managed super fund, which we're doing quite a lot of at the moment, both residential and commercial properties, we try to find something that's got a higher bias toward yield. Because because the tax concessions are not as strong. It's only a 15% tax rate within super. Therefore, you need to get a property that doesn't have a big cash drain on your big drain on your cash flow. The other
speaking of that drain on the cash flow, interest rates unfortunately are slightly higher for SMSF lending because it's a non-recourse loan, and there's no personal guarantees to the borrower. So if it is negatively geared, in actual terms, the good thing is that your contributions that you keep making will always be deductible, the concessional contributions. And eventually most negatively geared properties, if you're paying principal and interest, will eventually become positively geared inevitably. But at that point, the ongoing contributions are still tax deductible. So it's still somewhat like a negatively geared asset because you're paying it down with deductible contributions, which is fantastic.
I guess the only other negative is that in terms of the strategy of buying property outside your super, you can redraw and use that equity again inside super. You can correct me if I'm wrong, but you can't redraw that equity to buy your next one, can you?
Yeah, it's a great point to highlight, and it's probably the only reason you might sell an asset prior to sort of retirement age, just because you might have, let's say the property market doubles every 7 years. Well, then a $1 million property could turn into an $8 million property before retirement. You know, 1 into 2 into 4 into 8, 21 years. That's pretty much the investment cycle, or but before the cycle. And when, if you're 40 years old, you'd be starting to make this decision. You probably want to crystallize those profits before then. If you've got a $4 million property with only a $500,000 loan, it probably makes sense to sell that property and then maybe diversify, maybe buy some shares again, and maybe look at different commercial assets, or different property assets like commercial and residential. The good thing, though, if you do that and you do sort of sell a property before retirement, there's still also incentives on the capital gains at that point, only 10% as opposed to 24%.
Yep.
So still tax advantageous in every way, shape and form, you know?
It's a great, look, I love it. I think it's a great thing. A lot of our clients take advantage of it. So I think it's a great thing. If you don't have the right advice around it, get some professional advice. I'd advise talking to a tax accountant that understands self-managed super fund, talk to obviously Shore Financial, getting the right loans around that, but get the right structure set up, because you've got to get that bear trust set up and all the right borrowing arrangements set up.
Just on that note, a lot of people think that banks have pulled out of super fund lending. Yes, the major banks have, but there's been lenders that have come to the market specialising in self-managed super fund lending. We've partnered with a few. We're now really focusing on it the last couple of years. We've even launched a self-managed super fund lending product called Oceana Home Loans. We'll talk about that another time, but essentially now you can go up to 90% even as an LVR on your super fund. You can even have an offset account, so you don't have that equity issue. And it's not always just reliant on your historical contributions. You can make a commitment on future contributions for servicing as well. Anyway, I think that's enough about super. But let's talk a bit more about what you're seeing out there, areas of opportunity. I think I mentioned to you before offline. A hot topic at the moment that's coming up left, right, and centre is other markets of Australia to either purchase an investment or even move to. We're seeing, even in our own team, we've got a couple staff that are looking at relocating to WA for affordability reasons. Whilst it could be attractive from a housing point of view, but then everything else, I believe, in WA is more expensive just because it's actually the most remote city in the world.
It takes more money to cost to get things there, right?
Exactly, because the smaller
Transport
population and logistically
tyranny of distance.
Yeah, a lot more difficult. So Perth's a hot topic at the moment, and Brisbane, I won't say is a new hot topic because it's definitely not a new concept, but it's continuously being a hot topic. How are you looking at these markets compared to Sydney? Let's put your buyer's agent hat on.
Let's talk about We want to talk about location or opportunities first. I mean, I think we should talk about market segments first, maybe before we dive into sort of locations, perhaps. Theo. I think opportunities going forward. Like, a lot of people come to me and say, "Rich, is now a good time to buy?" And what's my strategy? I think any investor out there, first thing they've got to do is get a pre-approval. Know where they sit in terms of their budget. That's the first thing they've got to do, and that's how we work. We love to work with clients. In terms of opportunity, plenty of opportunities out there in the investment market, and I guess the kind of strategy that people might want to think about is buying and holding, and just, it's a pretty boring thing, but gee, it's effective. It is absolutely. A lot of people think they've got to get really sophisticated with their investment strategy, but you don't. You can just buy a great quality property in a great location and hang on to it.
And you don't need to spend much.
And you don't need to spend the world on it. Right? You can get a little bit more advanced, and you can do a renovation, you can do an extension, you could add a granny flat, and
On that note, are you finding people a little bit less confident to do that at the moment with the hysteria on construction costs?
Absolutely. There's a lot more hesitation to pull the trigger on that. I mean, I'm doing I'm doing a build, and I've just done a granny flat build myself, and cost a lot more than I thought it would cost, but it's going to be worth it at the end of the day. It's a pain to go through, but I know the result will be worthwhile.
The granny flat's another hot topic. At least that's a bit more calculated risk, and you know where you're going to land. Adding a level, or renovating a house where you're adding some serious value in terms of spaces. That's the scary one at the moment.
You can get a. I mean, I just bought a house up on the Central Coast into last year, or beginning of last year. Sorry, beginning of 2023, and I put a 3-bedroom granny flat on. So,
oh wow,
yeah, pretty smart little trick I've got up my sleeve to do that. So I turned the garage into an extra bedroom. So instead of getting $450 a week rent, I'm getting $590 a week rent with the extra bedroom.
And is there a bit of a communal space between the two houses?
Oh yeah, there's enough space. I've done a fence. It was a 750 square metre block. Both got backyards. Separate access, separate driveway.
There we go. So that's not this. You got a fence dividing the two properties.
Absolutely.
But it's still on title.
Still one title.
Yeah.
You don't subdivide. You can't subdivide it.
And then how does that work with things like water rates and the meters?
You get a separate water meter.
Yeah.
And you get a separate electricity meter. So you're much better. It's a nightmare if you have one water. Otherwise, you as the owner have to pay the water bill, right?
Yeah.
So you do separate metering, and then you can pass on the water.
And that's
the charge.
fairly easy to do?
Yeah, it costs about $1,500 or $2,000, I think, when you put the water meter in, but it's worthwhile.
And can we, just on a high level, we don't have to talk about your personal set of numbers if you don't want to, but on a high level, what have you then, what does that equate to as a yield on overall?
I'm happy to share the numbers. So
Yeah,
I paid $950 for the block of land.
Yep.
Bought it off market. Probably got about $50,000 under market value, just through my particular way I did the deal.
We're talking Central Coast, you
Central
said?
Coast, yep, just up at your minor. And so bought that, did a $30,000 reno on the house. So
Sorry to interrupt. Is there any specific reason why you minor?
I wanted to get something in that particular area that wasn't too far from the beach.
Sure.
And it fitted my budget and criteria. I didn't have any exposure to that market.
It's a bit of a hub to the Central Coast there, right?
Exactly. Yeah. It's looked really popular with both renters and first home buyers and that sort of thing.
Because it's also close access to the highway.
It's only 50 minutes from Sydney.
Yeah.
I mean, once you're on the freeway, you hit it in about 30 minutes, which is Warringah. So bought the house, did the reno.
30 grand reno.
30 grand reno. We're getting $795 a week for the house. And we're getting $590 a week for the granny flat. Now, the granny flat costs me a bit more than normal. It's $240,000 to build the granny flat.
Okay, I thought that was 30 grand for a second. I was like, wait a minute.
No way. So overall, it's about a 6.15% yield overall.
On the cost inclusive.
Inclusive.
Okay,
yeah.
wow.
But I probably added about an extra $150,000 worth of equity value in uplift doing both the granny flat and the reno as well.
So the one question that comes up with this is that what happens if you then want to sell it?
It's fine, easy. So another investor would buy it, or there are plenty of other families that would love it because they can put, a relative or have an extra form of income to pay down their mortgage. The number of people that kind of are negative about granny flats saying, oh, but it's going to detract from the value. Not at all. I tell you, there is so much demand out there. People are looking for opportunities to build granny flats and get that secondary income.
So the only issue that is just not two separate titles. So it's two dwellings on one title. The bank has no issue with that.
Exactly.
They just might not value sometimes it as two separate titles.
Exactly. But it's not a problem because otherwise, if you do two separate titles, right, then you've got to pay two sets of rates. So it's actually going to be more expensive as an asset holding procedure.
Yeah, that's fantastic. It's very common at the moment. Definitely, talking about in one of your core markets in the Northern Beaches, a lot of people are putting those granny flats in the sort of in the backyard as such, sort of little 2-bedroom ones.
Yeah.
So, what do you think they range from for someone to put a basic 2-bedroom granny flat? You think 150, 200 grand?
About 150 is probably a base model. Again, it depends where you're building them too, because you can build them out of brick, or you can clad them, or you can, there's different types of materials. So. Again, just build the spec to the area. So if you're going to build a granny flat, in a more prestigious market on the Northern Beaches, I'd be doing brick. But the problem with brick is, which I didn't realise at first, you lose about 100 millimetres of space because you're building brick. Whereas if you do it cladded, you actually get more internal area. So let's think about the skin of the building as well as when you're doing it.
Can we talk about another hot topic that's similar to that, but the whole sort of strata duplex thing where you... the state government in New South Wales has released some new laws around if the property is a certain size and a certain block size and the frontage is a certain width. It's quite easy. You can easily do a CDC build and split it into two townhouses, right? I think you've got some personal experience with that.
Yeah, it depends on where it is. Again, it's very, very location specific. Like there is a lot of proposals to do manor housing right across, or townhouses right across Sydney. That hasn't been rubber stamped yet by the local councils in a lot of different areas. Right?
Yeah. So to highlight that, state government has put these policies in place, but then the local councils have their overarching policies which interfere and say, no, we need a DA on that.
Exactly.
And we're not happy with that.
Yeah. But then again, back to the Northern Beaches, there's certain pockets of Balgala or Fowler where you can do it if the street frontage is good enough. But they're really high value. They're not like, I wouldn't necessarily call them for the average investor. That's going to be out of their price point. You're buying the land for potentially, $3 million. At
least, right?
Yeah, at least. Exactly, probably more.
Can we just talk the high level numbers? I think they need to be, is it a 500-600 square metre block?
I can't remember off the top of my head.
Because I think they just reduced.
I think it's over 500.
I think each block now, it used to be 800, I believe, and so each block when they get subdivided used to have to be 400. But I think they've just reduced it to about 500-600, and each block can be 250, 300. The width at the front is the big one where they need to be 12 to 15 metres. I think 15 by law, but they can accept down to 12.
Yeah, they're not going to bring in, like 4 metre frontages like in a lot of the inner west type properties where you got really, really sort of narrow terrace type housing. They're trying to keep some form of character of the housing. That's why they don't want to have really, really narrow frontages in those areas.
But talking about risk and reward, you have to be much more of a sophisticated investor for that type of sort of opportunity because
absolutely.
you're doing a knockdown rebuild. It's not like putting a 150 grand granny flat at the back. It's a much bigger project as such.
But I'm doing, I'll tell you another one. I'm doing another project up in Brisbane at the moment. I'm building 2 townhouses on the back of a block. It's a double block, and I bought it DA approved, so it was a lot less hassle, a lot less time to actually just go through and do the build. And
you paid a premium for the DA?
I did, yeah. You paid probably an extra 100 or 200K for the DA, but it saved huge amounts of time. But the build cost, get this, I thought it was going to cost me about 850. It's going to cost me about 1.1 to do the build.
Wow.
So, I knew that. I went into it, but I know I'm going to make it on the back end. So I'm not worried about it. Really well located, walking distance to the shops and a local hospital. It's only about 6 k's from the centre of town. So
can I understand when did those goalposts change? Did you do some DD before purchasing it to
Probably about 2 years ago, I started doing the DD on the building cost.
Okay.
And then when it actually came time to get a contractor builder to do that, I got 3 quotes. I realised construction costs had moved 20-30%.
So that was also a sign of the times.
It was a sign of the times. You couldn't do anything about it.
Yeah. Okay, so I thought from purchasing to then settling and starting construction, but you actually sat on it for a period of time.
Exactly.
Yeah. Okay.
Yeah. So what it is. But why don't we talk about some areas,
Yeah.
Theo, in terms of where I see sort of opportunities in different cities and different regional areas. So maybe why don't we just kick off with, say, Sydney? I think Sydney's a big market at the moment. It's got over 650, 700 suburbs to pick from. We're seeing some really good opportunities out in Western Sydney for people that are a bit more price conscious with the lower budgets. We've been buying houses with existing flats or with a secondary form of income or the ability to do that. It's hard to get anything sort of sub 1 million now with have both a house and a flat on board. But areas like that are tracking where the new metro line is going to go. So areas like St Mary's and those around Penrith area is really, really good. Also around Blacktown is really, really good too. So following where the train line and that infrastructure is going to go is fantastic. So definitely some good opportunities.
Price points there. What are you thinking on average?
So you're probably looking at sort of a really basic block around about 800K up to about $1 million. Yeah.
Okay, so it's still more affordable than most markets of Sydney.
Yeah, exactly. And we've achieved, pretty decent yields with the 2 forms of income, say around between $1 million to about 1.2. We were able to get about a 5% yield, which is pretty amazing for those.
That's fantastic. Yeah.
Back in the day, we were getting 10% yields when we were buying out there years ago.
Wow.
But that was back in the day. We can't get that today. Other pockets. I'm a little bit wary of the southwest of Sydney, areas around Luddenham and those areas around the airport where there's just huge amounts of land still to be released and currently being released. The problem is there's lots of population. It's not all about population growth. It's about how much land supply is in those areas.
So you're talking about that pocket that's basically the end of the southwest corridor there, where it's the outskirts of the city, and in that area, the land subdivisions are happening in every direction.
Correct. You go out to toward Camden and out where Picton and all those areas where there's lots of 5-acre farms being subdivided up into smaller residential lots. But the problem with that, if you've owned them for years, great, you're like sitting on a gold mine. But for the basic investor, I don't think they're necessarily the best areas to buy in.
Well, it's funny that you say that, and it's a good shout because the last couple of years, the growth in those marketplaces have been quite crazy, right? I think it used to be around, was it 800 grand for a house and land sort of package back maybe 2-3 years ago. Now it's more like 1.2. Yeah. It's had crazy growth. And same as rents. I think rents have gone up like 30-40% in 2 years there. But yeah, I guess you don't follow where crazy growth has already occurred, right?
That's right. You got to look. That's the thing. You don't want to pile in after everyone else has made their money, and then you sit on that for about 5 years and it goes nowhere. There's a thing called opportunity cost, and you'll be, wishing and watching everyone else have their properties rising in value, where yours is just sort of treadling away there on the treadmill.
So what other markets you love?
So in Sydney, we certainly love the eastern suburbs. Tightly held market, great market.
Obviously,
low supply. We do a lot of off-market transactions in that area, from anywhere from a one-bedroom in Potts Point through. We just transacted a $12 million property the other day in Wallara. So
why are you seeing these vendors do transactions off market?
You'll have to ask the vendor that. I don't know, but it might be that the agents convince them to have a crack at it. And a lot of properties in the east are always given to buyers agents first. You'll always find that we get an email or a phone call, say we've got. Every day I'm getting emails from agents saying we've got this about to go to market. Give you first dibs. Do you have a client? So it's a really good opportunity for us to get in there. But for the investor, I guess the more price conscious investor in the eastern suburb, there's some great units and townhouses to be bought in different areas. Again, Coogee, we really love, Randwick, all around Bondi, parts around Bondi Junction is great.
That's another good shout. We've got some clients at the moment looking at Coogee, and it's amazing that they're getting 5% yield in Coogee on a unit.
Yeah.
Gross, obviously, before sort of the strata fees and whatnot, but at least some of those older Art Deco blocks,
Well-built, yes.
they're well built with low strata fees. They might not even have an elevator, which is kind of good. You know, if it's only 1 or 2 flights of stairs, I'd rather keep the strata fees low than pay stupid amounts for an elevator or some services that the tenants don't really enjoy.
Exactly. Yeah. So that's a good market. Also, Northern Beaches, we're finding a lot of people that they can't afford to buy the houses, so they're buying the apartments and the townhouses. And there's a great variety of stock in those different areas around there.
I believe people were concerned about DY in the past, but DY is back. Is that right?
Yeah, I've been looking around DY for actually one of my son's friends. I just helped him buy a property. Wasn't actually ended up buying in Crow's Nest because I found a really good opportunity there. But look, the thing with DY, if you are going to buy there, just realise there's a lot of competition for rentals. It's one of the most densest populated suburbs in Sydney in terms of the Northern Beaches particularly. So you just got to be aware that you've got to price your rent right. But it's a really attractive area. It's being gentrified. I mean, that whole area on the Strand now, there's some great cafes. They've made a one-way traffic lane there. Great surfing beach. I'm often down there, or Long Reef all the time. It's really attractive,
I was speaking to the one of the principals of Novak there in DY, Mark Novak, and he's a character, and he was saying that the reason he's sort of promoting DY, not just by being a local and proud of the area, but also that all the neighbouring suburbs in terms of comparative rent, comparative prices for the units are far greater, and the disparity between the two is not justified, and he thinks that's just DY's naturally got to catch up.
Absolutely, yeah, definitely. I mean, there's a lot of suburbs, and we do a deep dive into a lot of the data when you do look at the disparity between a unit price and a house price. And the units, are just so way under that they're going to catch up over time.
Yeah, that's across Sydney in general at the moment, right? The units, unit prices have not grown as much as houses since COVID. I think basically because of lockdown and whatnot, people got sick of being stuck in an apartment during lockdown, and they craved space, and they might have moved further away from the city to get space and buy a house. But now the disparity is not justified once again, and we're going to probably see a run on units.
Yeah. So just changing cities for a minute. The other market we really love is the Brisbane and the Gold Coast. The Brisbane market, we're able to get quite easily 5% yields, 5.5% yields for houses. And it's a really strong market. So we track different particular suburbs as to their performance. And then when we've realised or find a market that really has kind of almost peaked on its growth, we move to the next market, often adjacent suburbs or 2 or 3 suburbs away. So we're buying areas, so for example, not as far west as Ipswich.
Yeah, I was about to say.
You don't want to go too far. You don't want to go into the Ripley Valley.
What's that? That's about 40 k's sort of southwest.
Oh, about 30 k's.
30 k's,
about 30 k's. But there's pockets of northern Brisbane and southwest Brisbane, particularly also around the Cleveland Bay area. There's some really good opportunities there for pricing.
Is there a rough rule of thumb for Brisbane? Because sort of similar issue that you were talking about with the house and land subs down to the southwest corridor of Sydney, there are a lot of house and land subdivisions occurring throughout to the outskirts of Brisbane. Also much easier to build units in Brisbane than Sydney. Supply of units is definitely stronger than Sydney. Is there certain rules like stay within a 20k radius of the CBD?
No, not really. I think the problem with those rules is they become too hard and fast. I mean, we've bought quite a bit in the Springfield area, which is owned by that very wealthy Malaysian guy, Maha Sinnathamby, and he's done an amazing job of creating a master plan community, and it's actually a really attractive area to live. And we've bought some properties in there for clients, and they've done exceptionally well. The rents are really high. So,
what are you talking about purchase price?
So let's say I can't show you. I wish I could. Actually, this is a live presentation, so we can maybe send some examples. But for example, we've bought there over the last couple of years an $850,000 house, now worth about $1 million within about a year and a half.
Wow.
Right? And we're at the time on the $850, we're getting $900 a week. That same house today is getting $1,000 a week.
So what's that? That's about 5%?
Yeah, just over the 5% mark. Yeah, absolutely. Yeah.
Yeah, wow.
So really, really strong results there.
And 5% yield for a house is not common in any other marketplace, really.
That's the thing. That's why we love this market. We can't find any other markets where you've got a world-class city. It's going to host the Olympics in 2032. Lots of great infrastructure. Every time I go to Brisbane, I really like it more and more as a city. I mean, we've seen huge numbers of migrants move out of Sydney and Melbourne. And go to Brisbane because it's cheaper, it's more affordable. Your median house price is between about $850 to $900, depending on what pocket you're looking at. It's Sydney's median just hit 1.6, So you're not quite at half the price, but significantly lower. And we've even got, people I know personally that are looking to move there because of that affordability angle.
Yeah, we've witnessed lots of clients that have moved to Brizzy, and the other area, like I mentioned before, is WA, Perth. So what are you seeing over in Perth?
Well, if you look at the numbers, or what do we call it, the days on market, where's my stats for days on market? It's just crazy. Perth is literally going off the charts, or has gone off the charts. And the problem I'm seeing for that is that you've got so many investors piling in there all at once that I just think...
You think it's predominantly investors? It's not just people sort of
I'd say
relocating?
I think it could be some relocators as well. But days on market, what is it for Perth? 11 days, down from 21 days.
Wow.
11 days to sell your house.
So
it just gets snapped up in a week, basically.
Yeah, you basically need to have a look at the first inspection and quickly make a decision.
Melbourne's 36 days, Sydney's 35 days, Darwin's 61 days, right?
So what was Brisbane?
Brisbane is 22 days.
Because I'm hearing similar stats out of Brisbane. There was a client of ours that just sold a property in Fig Tree Pocket.
Yep.
I think it's about 15 k's from the city.
Nice pocket.
Same issue. One open they had,
Yeah.
and they had 3 unconditional offers within
That's right.
48 hours after
That's
that one
it.
open, and they sold straight away.
Yeah, that's it.
It's not a problem, I should say. It's a fantastic outcome, but yeah.
I mean, that's the challenge. If you're trying to buy when you're living interstate, to try and actually get a handle on that market, if you literally try to pick up the phone and ring an agent, guess what sort of treatment you're going to get? Get in line with everyone. So for us, I've got a team of 5 buyers agents on the ground. A lot of the transactions we do are off market. We're first in there with the best offer. We get it unconditional. And buying in Queensland, we can buy subject to finance, subject to pest and build. So we get it under contract, get the property under control as quickly as possible. Then we complete our due diligence. We get pest and build done. We get valuations done. We check out the neighbours, make sure it's not in a flooding zone, do all of those checks and balances to make sure the client's protected in that process.
You can't really do that in other marketplaces.
New
like
South
Sydney.
Wales and Victoria, no, you've got to put down your 0.25% and you risk losing it, unfortunately. So.
Well, in the sort of hot markets of Sydney, you don't even get the cooling off period of 0.25%. It's 66W unconditional from day dot, right?
Exactly. It's tough work, you're right. Yeah. So other markets I'd also I'd talk about is the Gold Coast. We're really seeing some great opportunities on the Gold Coast, again, from a lifestyle perspective. And again, even apartments there. I was a bit anti-apartments because there's so much supply previously. But we recently bought a really high-yielding apartment, a 2-bedroom holiday let, which is getting a 9.7% net yield. Can you believe it?
Where are we talking?
This is on the Gold Coast. This is like Broadbeach.
Broadbeach, wow.
Yeah. So amazing. So $680,000.
It's not one of those big new developments, though, like the Jewel there.
No. The strata fees on that is phenomenal.
Yeah.
Don't touch that. But this is the thing. You've got to do your research, look at the occupancy rate, look at your strata fees, do all of your calculations work. Is it worthwhile?
Because to your point of DY and, when you put something to market to rent, you've got all these competitors, also, comparables, I should say, on the market as well. Same, I would have thought, in the Gold Coast, in markets like Broadbeach. If you're buying those big developments, there's so many options for other tenants to rent, right?
That's right, exactly. So that's where you've got to be really go in with your eyes wide open. Make sure you're buying in the right kind of building and the right kind of area where you're going to be able to lease it. And have a backup plan. If you're not going to do short-term letting and it's going to go into long-term pool, it's going to be the right sort of rental for you to hold it longer term. Another market, Theo, we still like is Melbourne. I think it's underperformed. As I said, it's only done 3.9% growth last year. And you don't buy necessarily on last year's performance. You buy on a 20-year, 30-year projection going forward.
Can we just clarify, is that 3.9 as dwelling total? Or is,
that's for houses.
That's houses.
That's for houses, yeah.
Okay.
3.9% for houses.
And you're recommending houses over units down there?
No, we're recommending both. I'll give you some examples. So again, various price points. We just bought an apartment in South Melbourne overlooking Albert Park for $650,000 and it's renting $700 a week. Really nice complex, only a block of 25 apartments, beautifully designed. The architecture in Melbourne's awesome, right?
Yeah, we used to have an office in Albert Park, so that's like the equivalent of Surrey Hills, really.
Yeah, exactly. So great, and as an expat client, super happy, great result. We're buying houses down toward the Bayside area, so say down toward Frankston, where you can still buy a house between like about 800 to about 1.1 million. Great family-friendly area. And we're getting yields, probably around 3.5% to maybe 4% there. But the growth rate is going to be very strong. And you're only, 40 minutes drive from the CBD down there as well.
To your point about not following historical data too much, Melbourne is one probably that's going to make people cautious. Well, I should say investors cautious, because unit prices, I think, in the last decade have only increased like 1 or 2%, right? And that's a supply issue, you would say. But you think units down there is...
Depend, again, very, very location specific. I mean, remember when Docklands came out? Everyone thought Docklands was going to be an amazing area to buy an investment. And I had a friend that, I've got a 3-year settlement. It's got to go up in value. Guess when it came to settlement, he lost 50 grand.
Yeah, the valuation probably came in short.
Exactly. So just be really careful. So again, just you've got to use a local person that understands those local dynamics, Maybe one thing, I don't know if I've shown you this before, Theo, we can share this slide, but I actually tracked all of the capital growth performance of all the major capital cities over a 25-year period. And then I projected forward 20 and 25 years to come up with the median house price.
Yeah,
so
wow.
If we want to shock
we'll share that one for everyone watching online.
If we'd like to shock our listeners and our viewers online, the median house price, the estimated growth rate for Sydney has been around 7.3% over the last 25 years. And the median price predicted in 2043, drum roll, will be $5 million.
Wow.
And in 2048, so that's 25 years' time, will be $7.9 million. And how do those numbers resonate with you?
Yeah, well, let's also highlight, as an investor, if hopefully the federal government doesn't make any changes to capital gains tax exemptions and whatnot, the reason why you should be attracted to some of these, asset classes being property is that you're only going to pay 24% on that growth, being a 50% discount of your income tax rate for capital gains tax. So they're extremely attractive. If you think about, what did we say there, 1.3 to 5 was it 5?
Yeah.
So you're talking a bit over $3.5 million in profit that you're only going to pay 24% on. Most other investments, if you're chasing, let's say a positively geared asset or a fund that's paying you a distribution, you're paying income tax on it, right? That's why you've also got to identify. We had a very successful investor night last week. We're going to revisit some of those subjects together with Rich in a webinar in a few weeks. I encourage people to hop online for that one. What we're going to cover there is identifying who you are as an investor, what is suited toward your circumstances holistically. That's general advice. You have to still speak to your accountant or financial planner about your individual circumstances. But people need to realize, do they want negative gearing? Do they want positive gearing, and why? We also cover a bit about the different investment structures. So your personal name, purchasing in your personal name, a trust, a company, or once again, super, and the benefits of each. There are CGT, or I should say capital gains tax implications for each as well. So excited to cover off those things with you.
Awesome.
In a few weeks. The other thing I thought that's worth highlighting, or was there anything else you
I
wanted
was just going to suggest, I just thought I'd share with the viewers our other median prices. So Melbourne is moving from a $923,500 median price today up to $3.5 million in 2043. Brisbane's going to go from $832,000 to $3.3 million, and Canberra $953,000 to $3.8 million. So pretty phenomenal figures.
And on sort of feasibility for people to try and make those investments, I guess, work, if you're just looking at it as an investment property, yes, ideally you want a 20% deposit plus stamp duty, and bear in mind in some other markets stamp duty is less than New South Wales. But you don't need a 20% deposit. You can just get away with a 10% deposit, even a 5%, but I'd say minimum just 10% plus stamp duty. So in most of these markets, in other states of Australia outside of New South Wales, or even in New South Wales, you could probably make an investment work with a bit over $100,000, really.
Correct, yeah, absolutely. I mean, I got an article quoted in realestate.com, what would you do with $100,000? How would you leverage it? And there's lots of other markets with $100,000 you can still buy into. I mean, as we've mentioned the Central Coast, but if you can do a higher LVR, it opens a whole range of opportunities, right?
And bear in mind, you don't need $100,000 in actual cash in your bank account to make this work. If you are already a property owner, we can do a valuation on your property and access the equity in your property. I think everybody remembers that ad from the 90s, equity mate,
That's the one, equity mate.
Equity mate. Get that equity working for you.
Love it.
It is also much more tax effective to use your equity than your own cash. If you have to and you do have cash, suggest paying down your home loan to use the equity to borrow against. But once again, a conversation for accountant. Was there any other markets?
The other markets I'll talk about is Newcastle. We really like the Newcastle market. It's still coming of age. Still lots of petrol in the tank left for that area. Great lifestyle. Getting higher yields than Sydney. So we're getting yields sort of 4.5% on average for most of the products there. And we really like all around Lake Macquarie as well. So yeah, really, really good market. Good access, only an hour and a half to Sydney. Good access to the Hunter Valley. Plenty of jobs, great cafes. You've got the new train line, the light rail that goes right into the city. All around the Honeysuckle Wharf is all being gentrified. And we're finding a lot of downsizers actually are also moving up there. A lot of kids are moving up to Newcastle. We've seen some people do lots of renovations and all of those. There's some really great suburbs in Newcastle.
It's funny. That's another thing that's been sort of vocalised a lot in the media at the moment is about downsizers moving to actually help the affordability crisis for their kids. Now, we're not talking about kids that are 18, 20 years old. We're talking about kids that are 30, 40 years old. And the downsizers are sort of sitting on huge amounts of equity in their home because they've had 2, maybe 3 property cycles in their primary residence. And so there's a bit of a shift now with downsizers cashing out, helping the family and going into something a bit more suitable for their stage of life as well. I just want to touch on, lastly, one of the major points that I wanted to bring you in here. You're big in the, I guess, the development space, the commercial space. Well, not so much commercial, but you also look at residential properties that you syndicate between investors. We have recently launched Shore Invest, which is exactly this as well. So you've got 2 different sort of people right now speaking about the syndication in different formats. So we're not biased towards one or the other because we do it in different ways. Shore Financial doing it in commercial and Rich doing it in residential. I think it's just worth highlighting, firstly, what is it? So syndication is when a bunch of investors pool their wealth or their capital together to purchase a property in a specific vehicle, usually a unit trust. In most instances, in the structures that we're doing in Shore Invest, the unit trust will borrow the money itself. There is no personal guarantees to the borrowers. So once again, like super, there is no personal serviceability, and it's not going to impact your future borrowing ability, which is a big win. We like it for our investors. I like it personally because you're getting exposure to different asset classes, commercial properties with higher yields. So we're looking at that $25 million to $100 million price range, which we syndicate. Reason being, you're sort of above the private sector and not really punting against the individual private investors, and sort of the entry level bottom end of those big institutions, the REITs, the real estate investment trusts like GPT, Stocklands, Dexus, and all those big publicly listed organizations. So you're getting good value, and you might get some assets like the building that we're in right now, which Dexus just sold. You might get it for good value because the fund manager, Dexus, might have neglected the asset because it's one of their inferior properties. And they're also focusing on bigger opportunities. You've got a bit of experience in this space. How has syndication worked out for you?
Yeah, so we don't do commercial syndication. We do commercial buying. So we act for a lot of both private investors, corporate investors, and business owners to buy commercial properties. And we've got a commercial buying division. And so we're doing a lot for clients that want to buy in self-managed super funds, for example, getting some great yields, typically 6% net plus. In terms of syndication, we do sort of just private work. We don't advertise it, but we just look for private investors that want to basically put equity or cash into a residential development. And they either become a shareholder within the development we're doing, or they just lend their money to us and we go and find an opportunity and give them either a cash return at the end, or if they put in a substantial amount, they could actually get property out as profit, which is a more sensible way to do it.
Wow.
Because if they can actually get, for example, a townhouse, instead of putting in, say, $700K in equity or cash, instead of getting $1 million out
that they pay tax on.
Hey, they've got $1 million property, and they've got virtually no tax to pay.
They don't pay tax if they just own
hold it. If they hang on to it.
If they hang on to it and just get the rent, they're not crystallising the profit as such. So you're holding onto an asset tax free.
There's a couple of smart ways through deed of petition where you can do that to actually do that. So we're constantly on the lookout for significant investors. I guess they've got to have that. Sophisticated investors. They really need to have that status. And there's been discussion about what the definition of that is. It's generally now at the moment $250K income or more than $2 million in net assets. But the government's talking of changing that that ratio. But they're the kind of investors we're looking for. Really, a minimum of 500K is what we're looking for anyone that wants to do that.
Fantastic. Well, once again, if you're watching online, there's more information right now that you can click on to go to our website about Shore Invest for more information. Lastly, I'm just going to give a plug into our State of Sydney report. This is a report that we've been running for the last 2-3 years now. It's actually what got us on Channel 9 News and 2GB. It's a report where we pull, I won't say we use some fancy tech guys with their AI. They're the brains behind it. But they essentially use real estate portal data. So all the data from websites like realestate.com, CoreLogic, RP Data and Domain. They pull all the information you could possibly pull from those platforms, such as, to Rich's point, days on market, asking price versus sold price, volume of listings, volume of online inquiry, and with that information, we essentially forecast areas of growth. Rich did have a look at our latest State of Sydney report that came out on Monday this week that just passed, and some of his favourite areas are in here as well.
Especially the professional phase. There's my backyard, mate. So.
Yes. So we've broken it down into 5 areas, basically defined by the median house prices in those areas. So Heartland Sydney, Suburban Sydney, Rising Sydney, Professional Sydney, and Affluent Sydney. Just to call out a few favourite hotspots of each one. So Cecil Hills and Bankstown is one of our favourite areas in Rising Sydney. Collaroy Plateau and Allambie Heights in Professional Sydney. So that's
Forestville, Killarney Heights, Belrose.
They're all looking at 4% growth in the next 6 months. Like I said, you can go on our website and get a copy of this report or just email info@Shore Financial. But to keep going, Affluent Sydney, places like Middle Dural, Curl, North Manly, Manly Vale, all looking at 4 to...
It's funny you mentioned those, just on, so go back to this one here on Manly Vale. I was talking to someone about that, which is Manly is one of the premier Sydney suburbs, a bit like Bondi. It's not quite as well known as Bondi, but just back North Manly and Manly Vale, wonderful little pockets. I've got some clients buying there. In fact, I'm transacting probably tomorrow on an off-market property in Curl, a beachfront position for exactly $4 million. So I've got access to some really good stock, but I do, and Narrabeen as well, some really good areas.
And I guess going back to my point about neighbouring suburbs and the disparity in price, so Manly Vale is next to Curl pretty much, and you look at the median house price in Manly Vale, 2.6 versus 4.08 in Curl.
Manly's not on your list there, but Manly's median house price is $4 million.
Yeah, right? There you go. So you're just one suburb back, and you've got a disparity of 40%.
Exactly.
So naturally, those gaps close over time.
You just don't want to buy on Condamine Street, right? There's particular streets you just don't want to buy.
Yeah, that's a bit of a thoroughfare, Condamine Street. So I won't go through all the suburbs, guys, but jump onto the report. Like I said, this report is heavily watched at the moment. We've compared our forecasts historically to actuals, and they've been pretty much bang on. So those guys behind the report are doing a great job. I hope that's a bit of a wrap for today's podcast. I hope you enjoyed that session. And like I said, dial into our upcoming webinar with Shore Financial and PropertyBuyer. Rich and I are going to be talking the things that we spoke about earlier, all the investment strategies that suit you, and a bit more of a holistic sort of presentation with some actual data to go through online. It will be an online webinar where you can ask questions and engage with us sort of at the end of the webinar as well.
Wonderful. Yeah, great.
Thanks, Rich, for coming on.
My pleasure. If anyone wants to get in touch with us, we're at propertybuyer.com.au and love to share information to help anyone that's looking to buy.
Fantastic. Thanks again.
Thank you so much.